cost. So cash cost per ounce. Um, this is the operating cost, and the companies are going to tell you what their cash costs are, and it's going to be a fairly accurate number. And ideally, you want it to be 1/3 of the spot price. So if you're at $1,800 gold, you'd like to see 600. That would be low. That would be a low gold price. 1/3 of spot. And then if it was 2/3 of spot, then it would be $1,200, which would be high. And so, right in between that, 800, 900 is that's kind of the marginal area. I would say 800 is fine, but once you get to 900, 1,000, that's really marginal. And then once you get to 1,100, 1,200, that's high. So it's like 1/3 of spot, 2/3 of spot. And I've seen over the years that that usually holds pretty true. And that's really what you want to do. So you want to avoid the high. Marginal is okay, but you got to be careful. It's like the only time you really want to go marginal is if they have a lot going for them, like exploration potential, um, good management team, long life mine. So that all comes into play. And then even the low prices, the low spot. I mean, that looks great, of course, but there's other factors that come into play. Um, and I mentioned that is generally reliable. So when the company says, okay, this is what our cash costs are, it's usually fairly close. ASIC, this is the all-in cost, and it basically ignores certain costs, such as exploration and development, which can be significant. Since it ignores certain costs, it's unreliable and misleading and always understates the break-even cost per ounce. So for me, as far as I'm concerned, the only thing that matters to me is the break-even cost. That to me is the all-in cost. So I ignore the ASIC, which is an accounting number, which again ignores a lot of cost. And you will never find a company who has an ASIC that is the same as the break-even cost. The closest you will find is a company that has really high production, say 1 million ounces of gold a year, and they have no debt. Then you will have the AIC will be somewhat close to their break even will be somewhat close, and they're not doing exploration development, very little. Um, but other than that, it's usually always you're going to need to pad it significantly. No, I don't know if significant is the right word, but you have to pad it somewhat. And I've learned that for gold, it's usually you're going to pad it around $200 an ounce, whatever this is, and for silver, it's about five, somewhere in there. But padding is one way to do it, but the other way to do it is what I'm going to talk about here. So this is the all-in cost per ounce, the break-even cost. So this is what I use to determine the free cash flow. So you have production ounces times the spot price minus the all-in cost. That's going to be the free cash flow if you have a correct all-in cost. Again, this is free cash flow, so that means the all-in cost includes taxes. It can includes everything, and taxes aren't part of there up here as well. So here's an example. So we have the gross profit. Um, this is how I calculate gross profit. It says GSD gross profit. So I take the net profit, whatever, this is a producer, and I remove their exploration and development cost. And there might be financial cost as well in there, but this is basically a ballpark. How much money they're going to spend on CapEx and how much they're going to spend on development. And then I come up with my gross profit. And then the net profit. So I have 10 million. Okay, so I have this is the net profit. So I have 10 million in net profit minus exploration 2 million equals 8 million. So my gross profit is 8 million. So then I have my revenue, which is 20 million, minus the gross profit equals the all-in cost, which is $12 million. And then from the 12 million, I can calculate what the percentage of revenue that is. So my total costs were 12 million, which is 60% of revenue. So then if I take 40% of the spot price, that's going to be my cost. So the revenue, it was 40%. So revenue was 60, so my cost was 40. So 40% of the spot price of I'm using 1800 as an example, is 1080. So this is the all-in cost per ounce, the 1080. So this is how you calculate. And then if you go and you look, so over time I've done this, then if you go and compare this 1080 to the all-in cost, you'll find, depending on how much they produce, the more they produce, the padding is a little bit less. But the padding, you'll find that the padding is going to be anywhere from, say, $300, $100 to $300, what they say that their all-in cost is, you know. So, and you'll learn that. So then you can learn how to do the padding. But this works out pretty well for calculating your break-even cost. So I'm not trying to be perfect here. I'm just trying to determine the free cash flow, the future free cash flow, or the current. This is actually current, but you can also do future as well. I do both.